Welcome to the Business Talk, a global podcast series that highlights distinguished faculty members and their impactful scholarly contributions. I'm Deepak, your host from India. We are delighted to welcome Dr. Orly Sade, Dean of the Hebrew University Business School, Albertson-Waltuch Chair, and Professor of Finance, as our distinguished guest on Business Talk today. Before we get started, I would like to introduce today's guest. A leading scholar in behavioral and experiential finance, Dr. Orly Sade serves on the scientific board of the Experimental Finance Society. Her pioneering research explores how financial markets are designed and how human behavior shapes their outcomes. Her work has appeared in some of the most respected journals in the field, including the Journal of Financial Economics, Management Science, Review of Financial Studies, Review of Finance, Journal of Financial and Quantitative Analytics, and Journal of Monetary Economics, among others. Dr. Sade's research has been featured and cited by major international outlets such as the Wall Street Journal, Financial Times, The Marker, and Jerusalem Post. A global academic, Professor Sade has taught and conducted research as a visiting associate professor at institutions including NYU Stern, Shanghai, IE University Madrid, EIEF Rome, and NES Moscow. She is a recipient of multiple awards and research grants from organizations such as Israel Science Foundation, the National Insurance Institute of Israel, the TIAA Institute, and using fintech. Her contributions to student learning have earned her letters of recognition for teaching excellence. Dr. Sade holds a PhD in finance from the David Esker School of Business at the University of Utah, an MBA from Tel Aviv University through an exchange program at the University of Rochester, and a BA in Economics and Management from Tel Aviv University. Beyond academia, Dr. Sade bridges theory and practice through her extensive service in the financial sector. She is a board member at Kellogg Insurance and has held advisory and governance role with the Israeli Ministry of Finance, the Israeli Securities Authority, and several major pension and mutual funds. Her career includes leadership positions within the Hebrew University's governance bodies and prior experience with the Bank of Israel's Banking Supervision Department. She teaches courses on fundamentals of finance, crowdfunding and alternative markets, and applied behavior and experimental finance, bridging her deep research insights and practical experience into the classroom. In today's episode, Dr. Orly Sade shares key insights from her prominent research using AI and behavioral finance to cope with limited attention and reduce overdraft fees. Let's not keep you waiting. Please join me in welcoming Dr. Orly Sade to the conversation. Professor Orly, it's a distinct privilege to welcome you to Business Talk. We are grateful to you for accepting our invitation.
Thank you for inviting me. It is a great pleasure.
Thank you, Professor. Professor, your paper combines AI with behavioral finance to tackle overdraft fees. What was the core motivation behind this research? And what gap in consumer finance did you want to address?
Now, what we were interested is two important aspects in finance. First of all, we were interested in understanding the human-algo interaction with respect to advising. There is a previous research that investigated nudging and advising and the way they influence human behavior. But what is special, if we think what is new relatively now, is the interaction with AI. We see that AI is being introduced in so many areas as a potential advisor, and we wanted to see how humans behave toward that advisor recommendation. Now, this is not just the idea that it is an algo advising, but one of the main advantage that AI can contribute is that it is as needed advising. It is a constant possible advising, which is a bit different than going to a human advisor in a particular date, in a particular time. The algorithm is constantly following us and advising us when it thinks that it should. And we wanted to see how humans behave toward that, and we think that this was something new and important. In addition to that, we did it in a very specific context, which is an overdraft fees. That is a problem that we see no matter where we look around the globe, and we wanted to understand how the intersection between these two important topics, how people behave towards something that is so common in human financial behavior, not sufficient fees, overdraft fees, and on the same time, how it is related and can it be mitigated with the use of algorithm.
Professor, you focus on limited attention as a key behavioral bias. How do you define limited attention in the context of everyday banking, and why is it so central to overdraft problems?
Well, when we are thinking about limited attention and we compare it to the traditional theories in economics and in finance, so the traditional theories assume that we are constantly evaluating and has accessibility and reaching all possible information. However, we do understand that sometimes information can be costly, can be complex, can be even overwhelming. And limited attention actually address that. It addresses the situation that either because there is high cost of acquiring information, and this can be irrational limited attention. At certain point in time, we may decide that we do not want to acquire additional information because it is just too expensive to acquire that, and the benefit will not be sufficient. But there is also psychological biases, such as the ostrich effect that this paper, the term was coined by a paper by Dan Galai and myself many years ago, in which sometimes psychological biases may cause us to ignore certain information and to have limited attention to that information. So it can be either rational or irrational. Now, if we think about banking and overdraft and things like that, these are routine activity that we are all involved with. And sometimes we see activities that just doesn't make sense. It doesn't make sense that people will pay a fee of $30 for purchasing a coffee that should cost something like $5. So we wanted to understand what may drive some of the activity around overdraft. And as I said, some of it can be rational. You may decide that acquiring something, even if you don't have sufficient fees and paying additional fees, can be rational at certain circumstances. However, we did see in the data many examples that illustrate to us that some of this activity is probably irrational.
Professor, what kind of AI tools or models do you propose or test in the paper? And how exactly do they help consumers avoid or reduce overdraft charges in practice?
So we are testing actually the behavior toward an algorithm that was designed by Intuit. They designed the algorithm based on different individual characteristics that they have in the data. What we contributed in the way that after the algorithm detect that you should be warned that you may be prone to have either a non-sufficient fee event or overdraft fee event, it sends you a message, but that message can be sent in different ways, in different framing, in different complexity. And our contribution was that we joined forces with Intuit and tested and manipulated the way that the messages were sent. And we found that that matters. And this is important because at the end of the day, we shouldn't only care about evaluating the probability. We want the individual to act upon it, and their decision to open or not open the message and to act and not act upon it can be driven by their ability to act. But what we show is that it is also driven by the structure of the message that we send. And that is important because that can be easily modified.
Professor, many banks already send SMS or app alerts. What does your research suggest about why these standard alerts often fail? And how can AI-driven behaviorally informed interventions do better?
Now, if you think about it, we are overwhelmed with information. We are constantly receiving so many information. But what is special about algorithm is that they can send reoccurring messages and they can send it in the right timing. So this additional component is quite important because it is totally different than just sending a warning or sending a warning when it is appropriate to you to act upon it. So this is one important component that we are testing and using, and an algorithm can add beyond just a regular SMS, and financial institutions are utilizing that more and more. That the fact that you understand that you receive it because it's actually useful for you among all that possible information. But what we also illustrate is that in this world where there is so much information out there, simplicity matters. So sending you a message is important because that's increase to some extent your ability to know that you need to act. We are so overwhelmed with so many things that sometimes we miss what we need to do. So just informing you, hey, you need to do makes a difference. But also the way that this is being sent, whether this is being sent relatively in a simple, clear message, apparently also quite important. And sometimes the tone can also make a difference. We find that the negative tone in this context can have an additional value. So it is not just the message, it is when it is being sent, to whom it is being sent, how challenging it is to follow upon it, and how it is being framed.
Professor, in your empirical results, what are the most striking findings about the effectiveness of AI-based interventions in changing customer behavior or lowering overdraft fees?
Well, first of all, I think that we believed that more people will react. That if you sign to a service that supposed to warn you, once you are being warned, you should act. And we saw that a substantial amount of people acted, but substantial amount of people didn't. So that was that is something that is important to understand. Now, what was also important is to realize that there are differences based on the income of the individuals that acted and those that didn't act. And we were thinking, hey, this is more important to people that have less amount of income, right? Because that additional fees is larger fraction of their income. And what we saw is that actually those with higher income acted, and that caused us to think a bit further and to realize, hey, they may want to act, those that have low income, but maybe they have less ability to do so. And that is also important. So with information, we can achieve only that much. And this is make us a bit more humble, understanding that we can warn people, but warning is an important factor, but we also need to realize whether they can act upon that warning or no. And this is also quite important.
Professor, how do you address potential ethical concerns such as privacy, algorithmic bias, or the risk that banks might use the same AI tools to maximize revenue rather than protect vulnerable customers?
I think that this is very important question, but I also think that this is true of also for human, right? Human advisors may be prone to biases, may be prone to manipulation. And also, algo advisors may be prone to biases, may be prone to manipulations, and so forth. So we tend to discuss it with respect to algorithm, but this is an important question, regardless with respect to advising. And this is where I think that a regulation should take into account the specific characteristics of algorithm and monitor their activity and set guidelines and understand what needs to be done. And at the same time, the company themselves should be more transparent with respect to what they are doing. And hopefully their reputation should matter to them. But this is an important question, but it is important to individuals, to humans, to algorithms. Some biases individual may be more prone to, some maybe algorithm may be more prone to, and with time, hopefully, and with more research, we will know more. So this is a very exciting time because we are testing, we are learning, and we are trying to understand, and technology is going very fast. So clearly we don't know everything, but hopefully with regulation on top of it, some of it will be mitigated.
Professor, your work sits at the intersection of regulation, technology, and consumer protection. What policy implications emerge from your findings for central banks, regulators, or consumer advocacy bodies?
I think that one important aspect is to realize that some of these innovations are not affecting the overall population in the same manner. And in some cases, it may, even though they may be more affordable, since there are additional barriers, it requires more substantial, more knowledge with respect to financial literacy. It requires digital literacy. So it may be that at the end of the day, it may increase the inequality rather than decrease the inequality. And regulators should be aware of that, understand that once we cut the middleman, the overall population needs to have a higher level of financial literacy to deal with the information, higher level of digital literacy to deal with this innovation, in order, again, to make sure that there is lower inequality rather than higher inequality. And additional important aspect, as I already mentioned, is that information can do substantial and can have a substantial effect, but it cannot mitigate all the challenges. If somebody doesn't have an income in their account, informing them that there is not a sufficient amount, if they know it, we're not going to solve all the problems. It reduces the cost of acquiring information. It is important in that regard, but it is not solving the whole problem.
Professor, did you find differences across customer segments, for example, by income, financial literacy, or digital engagement, in how effective these AI and behavioral nudges are at preventing overdrafts?
So we did find, and as I said, we were initially expecting that lower income individual will actually act upon this warning because the fees are greater part of their income. And we found the opposite. We found that individuals with higher income were actually acting upon this warning in a more substantial way. And in a different research, with Maya Aran-Rosen, that was my PhD student, and now is a researcher in the Central Bank of Israel, we found that in a different digital platform that the Israeli Treasury created for inactive account. Those with higher financial literacy were more active versus those with lower financial literacy. So with these innovations, they are very important, that they're helping the overall population, but it is helping more those that can act upon it, those that have higher financial literacy, those that have higher digital literacy. And regulators should understand that and either work harder to increase the financial literacy level of the population and the digital literacy of the population, or find additional mechanism to mitigate some of these differences.
Professor, looking ahead, how do you envision banks integrating AI and behavioral insights into their product design and communication strategies so that good behavior becomes the default for customers?
Well, this is this is a big question. I think that we are going to see substantial more AI advisors. I think that we are going to see substantial more use of technology, but at the same time, I also think that we are going to see more research that trying to understand better this human-algo interaction, how the algorithm advising us, how do we behave, and by our behavior, how do we influence the way that the algorithm is advising us. So we are going to see more research, more knowledge, and I believe that hopefully we are going to see more efficient behavior toward algorithm and understanding what they provide and what is their limitation. So it is going to be quite interesting period ahead of us, and there is a lot research in this area. So I'm very excited, and yet at the same time, admittedly, I'm also being puzzled and challenged by where it will take us. So more to come.
Professor Sade, I would like to conclude this episode with one last question. If you had to give one practical recommendation to a bank or one to a regulator based on this research, what would each of those be to meaningfully reduce overdraft fees caused by limited attention?
Well, as a researcher, it is very hard for me to say one particular thing, but if you push me toward that, I think that with all this substantial amount of information that we receive, I would say give the information, but make it simple. Make sure that it is easy to comprehend.
Thank you, Professor Sade, for sharing your insights and taking us behind the scenes of your research and practice in finance. It has been a privilege to learn from your work and your perspective today. We are grateful for your time and generosity in joining us on Businesstalk, and we look forward to following your future research and contributions to the world of finance. Thank you once again.
Thank you very much, and let's continue to talk about AI and finance, right?
Thank you.
Thank you.